Ora, muito boa tarde a todos. O meu nome é Ricardo Contins, sou gestor de produto no BiG. Sejam todos bem-vindos a mais uma sessão da Chicago Trading Sessions, a primeira sessão exclusiva para clientes BiG com plataforma. Eu agradeço a todos estarem aqui e pedi-vos, até ainda antes de começarmos, se nos puderem dar a confirmação que me estão a conseguir ouvir e que estão a conseguir ver o ecrã neste momento. Se nos puderem dar essa confirmação, perfeito. Eu agradeço de facto esta indicação. Iria pedir-vos a todos para darmos aqui 2 minutos apenas para que todos possam juntar, enquanto fazemos aqui uma breve introdução efetivamente. O webinar de hoje vai ser aqui sobretudo a execução de estratégias avançadas de trading. Relembro que este webinar vai ser em inglês, vai ser aqui em parceria com David Gibbs da CME e já terei aqui a oportunidade de o apresentar devidamente para este efeito. Uma vez que já me confirmaram aqui a vossa presença efetivamente e que conseguem ver o ecrã, iria aqui referir 2 ou 3 questões bastante relevantes. Este webinar e o próximo, da próxima quarta-feira, serão exclusivos para clientes com plataforma BiG. No final deste webinar, eu não direi hoje, mas possivelmente amanhã, os presentes irão receber um e-mail do BiG com alguma documentação específica e restrita aos participantes deste webinar, que basicamente passa por um PDF também em inglês, mas a dar aqui as principais estratégias, principalmente aqui na parte de opções, que foi algo que não explorámos aqui tanto nas sessões anteriores, focámos-nos muito em futuros e vamos ter aqui David Gibbs também a falar sobre algumas estratégias de futuros. Após isso, será aqui distribuído este flyer efetivamente específico sobre estratégias de opções. Então, e para todos os efeitos, quem é que é David Gibbs? David Gibbs, basicamente, ele trabalha há mais de 35 anos nesta indústria. Começou aqui em Chicago, nas bolsas de futuros, efetivamente. Ele está a trabalhar para a CME e é aqui um especialista a nível de estratégias, efetivamente. Como tal, é alguém que vai dar aqui uma visão, sobretudo, primeiro, genérica de mercado, como é que funciona futuros e opções, como é que se negocia já numa forma mais avançada, nada introdutório na realidade, e vai depois aqui falar sobre estratégias, ou seja, como aplicar estratégias específicas na negociação destes ativos. Relembro então que a sessão é em inglês, iremos então alterar aqui a língua para inglês. Dou mais uma vez as boas-vindas a todos e qualquer questão têm a linha de chat, fiquem totalmente à vontade. Se não se sentirem à vontade em colocar a pergunta em inglês, estejam perfeitamente à vontade para colocar em português e terei todo o gosto em ajudá-los a traduzir o que quer que seja ou até intervir se necessário em alguma explicação. Assim sendo, good afternoon to all. Thank you for all being here. We will begin our presentation about the new Chicago Trading session this today on advanced trading strategies with David Gibbs. David, I don't know if you are there. Can you hear me?
I certainly can. Boa tarde.
Perfect. Boa tarde, David. So, David is a director of education at CME Group. Is a professional with more than 35 years on this industry. Sorry, I'm a little bit lag. So I think it will be very, very useful taking us for a little journey on the futures and options trading. I don't know if you want to add something, David?
No, I'm ready to go.
Perfect. So your screen, your control, your everything. Please be our guest, and anything that you need, I will be here to help you in any way.
Wonderful, thank you. Good afternoon, everyone, and welcome to this session of the Chicago Trading Sessions. My name is David Gibbs. I'm with the CME Group in Chicago, and we're going to, as you can see by the title of the program, look under the hood at equity index futures, find out a little bit more about their mechanics, how they work, how they price, and how they might be useful to a self-directed trader in their activities, either from a risk management standpoint or from a tactical trading standpoint. The first thing I need to say is that as an employee of CME Group, this session from our perspective is meant to be educational and informative, and in no way am I giving investment advice nor making any trading recommendations. So even in the part of the program when we start talking about strategies, please in no way confer that I'm endorsing this type of trading. It's meant to be educational and informative.
Yes, of course.
The first, let's talk about what we're going to talk about today. I want to introduce the idea of indexing and then benchmarking, because these are the foundational aspects of equity index futures. And then we'll get into the pricing mechanics of the contracts themselves. And in order to refer to some of the aspects, we might have to refer to some examples or some aspects of the capital asset pricing model. Well, this isn't part of our agenda, but anyway, when broad market participants look at equity indexes, they use them from a performance measurement standpoint. In other words, if you're a large asset manager, you tend to be rated and graded and compensated by how you perform to a recognized equity index benchmark. And those benchmarks are different depending on the equity market that you're looking at, and also the focus of that region or that country's equity indexes. And let me give you some examples. Benchmarking and futures on equity indexes is a global business. What you're looking at is a chart, the data provided by the World Federation of Exchanges. And it's showing you the trading activity in stock index products, derivative products from around the world. And you'll notice that there's been a significant increase in trading activity from across the world in these products. We're going to be focusing primarily on stock index futures today. You can see a significant increase in trading since 2017 in these products. And that's not just at CME Group, those are at the derivative exchanges around the world. Just to put it in perspective, just in 2020, there was an over 60% increase in stock index futures trading. CME, of course, is probably one of the largest active exchanges in this product, and we have multiple products along this, but we're not the only ones. You can see, depending on where you are in the world, there's generally, if you've got a derivative exchange, you probably have a stock index future. And this includes Europe, Latin America, as well as Asia. There are even some products like the Japanese Nikkei 225 that are listed on multiple exchanges. The Osaka Stock Exchange, of course, in Japan, but it's also listed on the Singapore Exchange. And at CME Group, we have two futures contracts based on the Nikkei 225, one denominated in US dollars, the other in Japanese yen. So you can see it's a global business, it's a global industry. The main contracts at CME Group follow the main US benchmark indices. The S&P 500 is by far and away the largest. We're going to get into the details of that in just a few minutes. But there is also the Russell 2000, which is a small cap index, follows the smaller capitalization companies within the US trading sphere. And then the Nasdaq 100 tends to be more of a tech-centric index. And then there's the granddaddy of them all. That's the Dow Jones Industrial Average, which is really a smaller, large cap average of the 30 largest companies as determined by the Dow Jones indexing people. We're not going to spend a lot of time looking at the Dow Jones Industrial Average futures, but we are going to focus on these other three. I'm sorry, is there a question?
No, I don't think so, David.
Okay.
The participations are mute. I don't think so.
It might be useful, Ricardo, if you could mute your microphone while not speaking.
Of course, of course.
Thank you. To understand how the equity index futures work, you have to understand what goes into the underlying spot equity index itself. So let's focus on those three main indices at CME, the S&P 500, the Nasdaq 100, and the Russell 2000. If we consider the S&P 500, which is probably the one that's most recognized by large asset managers because of its size, it's huge. It's an enormous index. There's almost $14 trillion of assets benchmarked to it. It takes in 500 companies, roughly, large cap companies, and accounts for roughly 80% of the total capitalization of the US equity market. You can see that the top 10 constituents within the S&P 500, and they represent roughly 27 to 28% of the total index valuation. But it's a broad diversified index, taking in 11 industries in the index. So when we look at the S&P 500, we're looking at a large diversified base of large cap companies. The Nasdaq 100, another large cap index, is a slightly different configuration. It's also capitalization based, which means it's based on the amount of shares outstanding times the price value, and then calculated in an index form. But you'll notice something slightly different. The top 10 constituents here represent roughly 50% of the total. And that's because it does not include any of financial companies, and therefore becomes highly concentrated towards the technology sector. That's going to be an important consideration when you look at equity index futures, and why it's important to understand what stocks make up the constituent members of that index. The Nasdaq 100 tends to be a tech-centric index because of the composition of the index itself. And then we have the Russell. The Russell's also a capitalization weighted index, but it takes into account the small cap universe. These are smaller companies within the US equity market space. And if you look at the top 10 constituents of the Russell, many of these companies are going to be new to you unless you understand and have been tracking the Russell, because they're smaller. They're not common household names, but they are broadly diversified over those 11 industry groups. So it's similar to the S&P 500 in that it's diversified, but it's different than the S&P because it represents small cap companies, where the S&P 500 represents large cap companies. The Nasdaq 100 is like the S&P in that it represents large cap companies, but it's different than the S&P 500 in that it concentrates those large caps primarily into the technology and non-financial industries. So now you've got a little bit of an understanding about the indexes themselves. Let's take a look at the standard E-mini contracts. These are the bigger contracts that all of these trade on CME's electronic platform known as CME Globex. You'll notice a few things about the futures contracts that are standardized. They all have a fixed multiplier, and for the E-minis, these are larger. You multiply the fixed multiplier times the index value, and you get the notional or the financial equivalent of each of the contracts. Now, because the stock market tends over time to go higher, the notional value has increased over the years. And because of that, it has become prohibitive in the E-mini contracts for the smaller investor to be involved. The risk level has just become too great. So to remedy that challenge, CME began listing micro E-mini contracts on the same indices. So you've got the same market indexes here with different trading symbols with smaller multipliers. Notice the size, the multiplier is smaller. The index value is still roughly the same because it's the same index, but the notional equivalent now is at a size that's achievable and usable by the self-directed retail trader or the smaller asset manager. And this is important because we offer these contracts in these two different sizes to make the market more accessible to more market users. Now, the daily settlement is based on where CME sees activity in the last 30 seconds of trading in the afternoon. So in Chicago time, at 2:59 and 30 seconds to 3 p.m. Central Time, the clearinghouse takes a weighted average of what's going on in the E-mini S&P and establishes its daily settlement value. Now, you may be aware of how Globex works, and that Globex electronic sessions open till 4 p.m. So the market will continue to trade for another hour after the daily settlement's been achieved. But for mark-to-market purposes, this is the final daily settlement at 3 p.m. Chicago time. Globex stays open for another hour until 4, then it closes down for 1 hour and reopens at 5 p.m. Chicago time. So for example, in today's trading session, which is the 6th of October, our session actually began at 5 p.m. yesterday, at the 5th of October. So we trade around the clock, beginning at 5 p.m. Chicago time and trading all the way through to 4 p.m. the next day or today, where the market shuts down for 1 hour for a technical reset and management functions. The final settlement, when the contracts expire on the third Friday of a quarterly contract month, is settled to what's known as a special opening quotation, or shortened to SOQ. And this is determined by the index's index provider. So for the S&P, it's calculated by the S&P indexing people. For the Nasdaq, it's done by the Nasdaq people. For the Russell 2000 index, it's done by the Russell people. They take the actual opening values of all the constituent members of that index based on the actual first trade on the third Friday of the month, and then they calculate their index based on those inputs to arrive at this special opening quotation. And on the last day of trading, that's what the futures contract settles to. So it settles to spot on its expiration day, and that's an important thing to remember. You saw in that global indication of equity index futures, the growth since 2017, and certainly the same thing is true here at CME. Both the volume and the open interest has increased very nicely. What you also will see in this slide, which is represented by the darker blue, kind of the matchstick or the tip of the matchstick tip here, the dark blue represents the increasing volume coming from options on these futures contracts. And we're going to talk about some of those further on in today's presentation. But you can see that the activity and trading volume in equity index products is very, very significant at CME. Another important thing to be aware of is the notion of liquidity. And liquidity basically is about market activity, the amount of buyers and sellers, and the size of their orders in a product. Deep, actionable liquidity is absolutely essential to have a healthy market, and it's absolutely essential from a trader's point of view, because in illiquid or less liquid markets, it's very difficult to get in, and more importantly, it's very difficult to get out. So you want very, very liquid markets with lots of market participants and lots of bids and offers, both in terms of the amount and the types of users, because it therefore becomes less expensive to get in and get out. To give you an idea of the liquidity of the E-mini S&P market, if you compare in notional equivalent terms the daily trading volume of just the E-mini S&Ps with the total trading of the US stock market and the cash market, it's greater. In other words, there's more trading in E-mini S&P futures in notional terms than in all the cash transactions in the US stock market. And if you compare it with the notional equivalent of all of the ETFs that track the S&P, it's usually 10 to 1. So the futures contract, as measured by the E-mini S&Ps, is 10 times greater than what takes place in the ETF market here in the US. That means that you can get in and get out of E-mini futures at a much lower market impact cost than equivalent S&P derivatives. And the other advantage is that this is open 23 hours a day on Globex, so that the liquidity exists, and it exists not just in US trading hours, but around the clock as well. So let's look at these E-mini futures contracts, or in the case of perhaps your interest, the micro futures, which is the smaller of the two. I'd like to compare a micro E-mini futures contract based on a price of 43.84 in index points. If you multiply that times its fixed multiplier of $5, you get a notional equivalent of $21,920 per contract. Now, it must be stated here that a futures contract is not an asset. It does not convey any rights of ownership. It doesn't allow you to participate in dividend income, for example. You don't own anything. It's basically a price point in time. It has an index value and it has an expiration date. But because it converges to spot at expiration, it has to account for the cash flows in there. So it does include the dividend income stream in the futures price calculation. But what it doesn't require is full payment for its notional amount. What we require at CME is what's known as performance bond, and that's sometimes referred to as initial margin. This is different from securities margin. If you're used to trading stocks and you're familiar with buying stocks on margin, that's a different concept. That means that you borrow funds from your broker to buy the listed shares, and you pay interest on the borrowed amount out of your trading account. Margin at CME refers to the amount of collateral that must be posted before a position can be secured or executed. And it's usually a small fraction of the notional amount. You'll notice it's roughly $1,300, $12,065 here is roughly 6% of the notional equivalent value. Now, if you compare that to a CFD in Europe, in order to get the same or roughly equivalent dollar amount, you would need to buy 50 of them. And if we consider the price of the SPY on which the CFD is based, you would get roughly the same amount in notional terms, close to $22,000 equivalents. The margin required in euros would be 37 and 60 euros, or approximately 20% of that notional value. Plus, because you're actually purchasing something that's got an asset attached to it, there's what's known as a management fee or a financing fee in addition to the equivalent margin. So you can see when you're trying to replicate the beta or try to replicate the S&P 500, these two are not equal in terms of capital required to replicate the same position in the equity index market itself. Something for you perhaps to consider. So who uses these contracts and why do they use them? Well, with respect to the E-minis, the bigger of the two, the standard futures contract, it's used by quite a lot of different users for a lot of different reasons. And what I'm showing you here is open interest data that we report as a clearinghouse to our federal regulator, the CFTC, the Commodity Futures Trading Commission in Washington, D.C. That's our federal regulator. They in turn take this data and put out a report called the Commitment of Traders Report every week. And in that report, they show the public who holds the open interest, not the account holder's name, but the type of business that they're in. And this is available to anyone. All you have to do is go to the CFTC's website and look for the Commitment of Traders Report. In financial products, they break it down by the reporting industry that the account holder is in. Dealer intermediaries, asset managers, leverage funds, and others. Dealer intermediaries represent people who act as agents for others. These would be banks, broker-dealers, people who represent or do business on behalf of others, or might be making structured product in a competing OTC type product. Asset managers and institutionals are actual asset holders. These represent pension funds, endowments, insurance portfolios, and mutual funds, and also ETFs that are actual asset owners within a product group that may be using the contracts to replicate beta or to hedge their market risk. Leverage funds are who you think they are. These are going to be hedge funds and CTAs that do business for other people, and they may employ leverage in their trading activities in pursuit of a higher rate of return. And then the others are just people that must report that don't fall into those first three buckets. For the larger standard accounts, the activity in the index futures tends to be dominated by real asset owners. And as you can see by the blue column that represents long positions, they tend to be more long than short. And there's an important reason for this. They're using the futures market to replicate the beta of the underlying stock market. And they do this because as asset owners, they've got money constantly flowing in and flowing out of their activities. And rather than have to rebalance and purchase and sell shares every day, which would drive their performance down, they use a small allocation of cash capital to buy the futures contracts, put up the performance margin required to secure those positions, and stay fully invested to their benchmark risk by using the futures contract to stay invested. So you can see the activity in the E-minis is well diversified across all of these asset groups. It's both long and short, but also dominated from the long side, particularly by the professional risk manager. If we look at the micro, the smaller contracts in S&Ps, you'll see an entirely different picture. Fewer institutional users because they prefer to use the bigger size contract because it takes fewer contracts to do what they're doing. You'll notice the dealers are also less involved, but they are to a smaller extent. This world is dominated primarily by leveraged funds and others, which are going to be self-directed traders. And they're using the contracts, and that might change depending on the week with market flows. One of the reasons I draw this report to your attention is that many traders in the US that trade for themselves like to refer to the Commitment of Traders report to track who's long and who's short on any given week. It doesn't give them a complete picture, but it shows you who's active in the futures market relative to the underlying index. All right, now let's get into the mechanics of the contracts themselves. And now we're considering the micro E-minis. You'll recall from my comments, each index product has a fixed multiplier. And we're using it as an example, the S&P, but the same principles apply to all of the other, the Dow Jones, the Nasdaq 100, and the Russell 2000 futures. They have a fixed multiplier, which you multiply times the index value to get the notional or the financial equivalent value of the contract. So in this case, on this day, the micro E-mini had a notional equivalent of close to $22,000. Now, obviously, if the fixed multiplier is fixed, as prices move up and down, the notional equivalent goes up as prices go up, and it falls as prices go down. That's an important caveat to be aware of as well. A couple of other observations. Notice that the volume and the open interest tends to stay in the front quarterly futures contract. This is common in both the E-minis, but also in the micros. The volume will stay and the open interest will stay in the front quarterly contract until roughly the second week of December. And then it will begin what's known as its quarterly roll. And the volume will gradually, rapidly, roll into the March contract. The open interest will roll down into the March contract. These are cash settled, so you don't have to be concerned about a physical delivery mechanism. But if you're in a futures position for December, and as you approach that third Friday, you're going to notice that the volume in the open interest is accelerating its prevalence into the deferred or the March contract. If you want to maintain an outstanding risk exposure in the S&P or any of the index products, you're going to have to roll forward. The most efficient and effective time to do that is usually 3 to 5 days prior to contract expiration. That's when the bulk of the open interest is rolling. That's when the volume and the spread is the greatest and most liquid, and it's when you'll find the tightest bid to offer spreads. Another key factor to be aware of, notice the futures prices relative to time. As you go out the forward curve, you'll notice, at least in the micro E-mini S&Ps, the futures price is going lower. That's telling you something about the futures price. It's trading at a discount to spot, and it gets deeper discount over time. This is the result of its futures pricing mechanism, which must take into account the dividends and the financing costs. These two together, along with the value of the underlying spot market, determine the basis of the futures contract. And basis is a futures term that refers to the difference between the futures price and the spot price. The value of that basis, in the case of an equity index contract, is based on this differential between the dividend income stream and the futures price. If the dividend futures stream in yield terms is of greater size than the financing cost, you have what's known as positive carry, and that's what we're dealing with in current market conditions. Positive carry means there's a time value of money in the real asset as opposed to the futures contract. And since the futures contract has to account for that time value of money, it discounts over time. If the dividend stream were lower than the financing cost, we would be pricing at a premium, and the futures would be going higher over time. And this is the result of the spread between what's roughly, we're somewhere around 140 basis points on the dividend income stream versus a rate of maybe 15 basis points on the financing costs. So as long as the financing costs are lower than the dividend stream, futures will trade at a discount. But regardless of whether it's a discount or a premium, it converges to spot at expiration. So now let's look at the indices themselves and look at our major broad indexes from the middle of last year, July of 2020 to July of 2021 this year. You'll notice if we look at the changes of our broad market indices, the Russell 2000 small cap index did considerably better than its large cap comparative indices, the Dow Jones, the S&P, and the Nasdaq 100. In other words, it outperformed in a price rising market, and not to a small degree, but to a large degree compared to the large cap universe. In other words, the small caps during this period of time outperformed large caps by a pretty significant degree. Now let's focus on just this year, and I'm just looking at the first 6 months of this year. Notice the difference in the change this time. The Russell underperformed, and again, not by a small degree, but by a significant degree, the two larger cap indices, the S&P and the Nasdaq 100. This is known as dispersion between the indexes, and this is very common when markets are in fluctuation. You would maybe like to think that all indices kind of go up uniformly. Well, they tend to follow a similar pattern, but they don't follow each other exactly, and that's because of the constituents that make up the index. And because they're highly correlated, but not 100% highly correlated, this allows us to do what's known as relative value trades or spread trading between them. And what I'd like you to consider now is an example of an index spread buying one index future and selling another simultaneously against it, which is known as a futures spread trade. The idea behind a spread trade isn't to necessarily get the direction of the market right, going up or down, but it's the relative difference between two index products that we're trying to capture. So let's take a look at our broad market indices, looking at the micro E-minis, looking at the micro Russell 2000 and the micro Nasdaq 100s. And you can see for the period considered here, they're all pretty much trending in a similar pattern. In this case, the Nasdaq has a slightly higher, significantly higher index value, so it's represented in the index on the right. But they're all trending a little bit unchanged to slightly higher. So to look at a relative value trade or a spread trade, you want to remind yourself of the index constituents itself. Remember that the S&P is the broad market large cap index. The Russell is a broad market small cap index. So if I'm comparing the Russell 2000 to the S&P 500, the relative difference between the two is small cap versus large cap. If I wanted to express a point of view one way or the other about that relationship, I can do that using index futures. Let's consider a trader who believes that the small caps will outperform large caps. In this case, if I wanted to express that point of view, I would want to buy the micro Russell 2000 index futures and sell an equivalent notional amount of the micro E-mini S&P 500s, with the idea that while the two futures contracts behave in a highly correlated manner, they're not perfectly correlated. How do we arrive at that spread ratio? It's using the notional values of each contract. So if we were on the 19th of July to consider this trade, we would buy the Russell 2000 micros and sell the micro S&Ps. To do that, we need their index amounts and their fixed multipliers. Then they both have a $5 fixed multiplier. We get their notional equivalents and we divide the S&P into the Russell 2000, and you'll see it's roughly half. We need twice as many Russell futures to equal one E-mini. So let's consider a spread buying 20 of the E-mini Russells, selling 10 E-mini S&Ps, and see what happens. Here's the market from the 19th of July through the 2nd of September. Both index, let's just track the E-mini S&P or the micro E-mini S&P. You'll notice the market traded higher by measuring the broad market S&P. What did the spread do? 2 to 1. Well, you can see it moved, it sold off a little bit, and then it rallied back. Let's see what our market did. The S&Ps were up by 6.7%. The micro Russells up by 8.2. If we were to offset that trade on the 2nd of September, here's the result of your transaction. You made 284 index points, the micro E-mini S&P was up by 284 index points. The Russell 2000 micros were up by 174.2. So by being long and short, one leg is going to return a gain, the other's going to lose. That's common in a spread trade. Again, we're not necessarily interested in getting both legs directionally correct. We want that differential between the two to be correct. And you'll notice that the loss on the E-mini micro S&Ps was less than the gain of the micro Russells. It's that difference that mattered. So in the spread itself made a little bit more than $3,000. And it was a lower directional risk trade. And because of that, and this is another thing that might be of interest to some of you, CME clearing looks at risk positions like a spread in its net risk terms. And because these two products are highly correlated, there is a margin relief of 70% over the outstanding legs. So if you were to calculate your initial margins based on outright open leg positions, it would have taken you almost $27,000 of initial margin to secure this 20 by 10 future spread. But because of the 70% offset, the initial margin would have been reduced considerably to roughly $8,000. That means that the rate of return on capital is significantly higher, and that may be of interest to you. Now, obviously, margins are subject to change, and depending on volatilities, the offset is also subject to change. So consult with your broker prior to considering these trades to get the facts on where the margins are, where the spread equivalents would be. The next thing we want to consider is options on equity index futures, and CME lists options on micros and also on our E-minis. They're heavily traded, at least in the E-mini platform, and it must be mentioned here that the options that we're talking about are options that have as their underlying a futures contract position and not the spot index. So if you were to be long an option at CME in equity index futures, and you exercised your right, you would be exercising into a long futures position. If you were short and you get a sign, you will be held accountable to be able to create the offsetting position in the futures market. That's important. Let's consider a couple of concepts about trading options on CME's equity index products. You may be familiar with options trading, but just a brief review. An option gives the buyer the right, but not the obligation to take a long or a short position, depending on the type of option that you're buying. And in this case, it's a long or short position in a specific futures contract at a specific price on or before a specific date. The buyer of the option pays what's known as the premium for this right. The seller receives the premium, and the seller receives the premium with the caveat that they will be responsible for the obligations. They get to keep that premium whether the option is exercised or not. What goes into the pricing of the premium? Lots of things. The price of the underlying, which in CME terms means the futures contract. The strike price of the option itself relative to the movement in the underlying, market volatility, and the amount of time between the execution of the trade and the expiration of that particular option. One of the most common measures of option volatility in the US, particularly in the S&P, is an index product known as the VIX, and this is a trademark product at the CBOE, which is a competing exchange in Chicago known as the Chicago Board Options Exchange. VIX is their measurement of volatility on the S&P 500, and I use it as an example here just to show you that as the stock market, as measured by the S&P, has traded up and down, so has volatility as measured by the VIX. And you'll notice it tends to trade higher when the market sells off. It tends to trade higher in volatility as the market sells off. It tends to trade higher as the market sells off, and so on and so forth. It's not uniform, but it tends to be highest when the market's volatile, particularly in market declining days. Not uncommon like what we're seeing in today's market action. Let's consider a couple of options strategies that might be employed that tend to be directionally neutral but would benefit from rising volatility. And I'm going to give you two examples. Again, remind you that these are not trading recommendations, but are merely meant to be illustrative from an educational standpoint. A very common options spread that captures a sharp and very quick move in the underlying, regardless of market direction, is a trade known as a straddle. It's called a straddle because both the long and short position, as measured by a put and a call, are at the same strike price. You'll notice in this example, we're buying the straddle, buying the same strike. The futures contract underlying this option is the December E-mini S&P for December delivery. These are December expiring options. The market was at 44.31.5. The at the money options are the 44.30 strikes. And by buying both the put and the call, you're said to be straddling the market. And since you're buying them, you're having to pay the premium, and you're paying an enormous premium because you're buying two at-the-money options. They tend to have very high premiums. What you don't have is a lot of delta. In other words, your exposure to market direction is very, very small here because you're buying both the put and the call. Your gamma is significantly higher because you're buying both options. And the vega, which measures the sensitivity to increases in volatility, is also significantly great. But because you're buying two options, you also have an enormous amount of time decay. This is important. Now, what might make this trade work and make it worth the expense of buying a high premium spread is that you expect the volatility to rise. Now, the important thing to remember in an options trade is, since this is a debit spread and requires you to pay the premium, it also represents the maximum amount that you can lose. Your risk is defined by your total premium. This is an expensive trade, but it means you can't lose more than $13,475 on a total position. Now, what might make this work would to see the market explode, and you don't care which direction it goes, as long as it goes there in a big way and quickly, because time is working against you. The sooner it moves, the sooner you make your money. You've got an unlimited theoretical return on a straddle, assuming the market goes quickly and moves in a big way away from your strike price. Time decay is your worst enemy, because of the you're at the money and you're long both the put and the call. Time decay, as measured by the theta, is going to be eroding the value of your premium every single day you're long. The break-even point on a straddle is determined by adding your total premium, that's the amount you paid, the $269.50, to both the put and the call's strike price. So in order to break even, you've got to move way out on the curve in one way, in one direction or the other. And the sooner you get there, the better. If the market expires, if your options expire before you've gotten to either one of those extremes, it doesn't make any difference what the volatility is. The thing's going to expire worthless. Now, another example is a strangle, and it's basically doing the same thing, but you're paying less for it because you're not at the money anymore. You're using out of the money puts and calls, and in this example, I've chosen 2%. In other words, you take the current I've taken the current market level and moved out, down in, as far as the puts, and higher for the call by a 2% factor. The premium on this is significantly lower, but it is still rather large. You'll notice the gamma is still considerably larger than just one leg or the other. The delta is very small because you're less directionally sensitive. You just want the market to move big in one way or the other. The vega is still large, which means you'll benefit from rising volatility. And the theta is also large, so you're going to be swimming against time decay. But it takes less of a premium outlay. It also may require less of a move because your break even is going to be, again, similarly, you're going to take that combined premium and add it to the put, subtract it from the strike price of the put to get your downside break even, and add it to your call strike price to get your upside break even. But again, the key component in here is that you've paid the premium to restrict or limit the downside risk of being wrong, but you'll participate in an unlimited fashion if the market gets beyond your break-even point in either direction. And while you're waiting for that, you're being consumed by time decay. The sooner it happens, the better. Now, you'll notice that I've used examples here from a tool that's available on our website called Quick Strike. This is available for you to see at cmegroup.com. Here's the link. And you can see all kinds of useful things on Quick Strike, including the expiration calendars of all CME options based on the product. You can put in the product that you want at the top, and then look at the expirations. And you can see here with E-minis, there are so many that I could only put a couple of lines here to give you an example. But we have in our micros multiple listings versus the equity index products. There's also other analysis that you can do on QuickStrike on the free tool that's available on the website. So by all means, please check that out. And then the last part of my formal remarks that I want to draw your attention to is our learning portal, which is called CME Institute. And you can get to it by clicking on the education tab on our website, cmegroup.com, where we have an enormous amount of resources, courses, archived webinars, as well as third-party white papers and other interviews with people on all of our products, not just equity index products, but every asset class. It's available to you free of charge, and you can look at these things at your own time, at your own space, and in your own speed by accessing us online. Ricardo, that concludes my formal remarks. I'd be happy to take any questions that you or your audience might have. And the last thing that I would leave you with is that you can always reach me via email, which you can see on the screen at the moment. Do you have any questions for me at this point? If not, then I will leave you with, oh, are you there?
Yes, I am here. Can you hear me, David?
I can. Do you have any final thoughts or questions that we want to cover?
Yes, some of our participants are asking about the CFTC report that you mentioned earlier, and how could they access it? If you could show us, please.
Yes, you get to the Commitment of Traders reports two ways. You can go to cmegroup.com, and we have the Commitment of Traders reports on our tools site, where we've taken the information that the CFTC publishes and reformatted it on our website. Or you can simply go to cftc.gov in the US and look for their Commitment of Traders reports, or just Google CFTC space COT reports, and it'll take you there. This is public information. Anybody can see it anytime. They update it once a week, and many traders like it and use it as a technical indicator in their formation of their strategies, or at least in their intelligence gathering. So you can either go straight to the CFTC's website, or you can use the tools function at cmegroup.com. Either way.
Okay, thank you. Another question from our participants is if someone, and for example, wants to be long on the S&P and is reaching the termination of the contract, you refer earlier that 3 to 5 days before of the expire of the contract would be a good day to consider to roll over the contract. Can I ask if there is any other strategy? What is the risk of staying to the last day of the trading day of that contract before the rollover? Sorry for this last part.
The risk is very simple. If you stay in an expiring contract, on the last day of trade, it settles to its spot value. And depending on the previous day's settlement price, you'll either be credited or debited the difference in your trading account, and the contract expires and ceases to exist. That's a perfectly fine way to end your position. The reason to roll forward would be if you want to maintain a risk position in the futures contract, you will have to go forward in time to the next available or to any forward open futures contract prior to the expiration, or your contract will be settled to cash. The roll in that last week, that third week of the quarterly contract, is when it's most liquid as a calendar or a roll trade. And the other thing to note there is we tend to trade those E-mini S&Ps anyway in quarter point increments. The rolls or the calendar spreads trade in 0.5 increments. So it's less of a market impact cost to do the calendar spread to roll forward. So if I'm long December and I want to stay long beyond the third Friday of December, I would sell my December position as a spread trade and simultaneously I would become long the March futures contract. That involves selling the December contract and buying the March contract, and that's done as a spread trade at a spread equivalent, the price difference between the two, and those are quoted on the screen, and they're traded in 0.5s rather than quarter points. So it's a very, very efficient way if you want to maintain that exposure to roll forward rather than to offset and then repurchase your March position, which would be called legging the spread. It's more expensive from an execution standpoint to leg the spread than to do it as a spread trade.
Okay, thank you.
Yes.
I have another question from another participant about the following. If someone wants to have exposure to the S&P, for instance, as an index, as a part of an investment strategy, if it would not be better to choose initially a longer settle date than go to the first contract, because you will have a discount on price.
I think that there's some logic to that thinking. Yes, as long as there's positive carry, there's a deeper discount further out. But the only problem or possible problem with that would be you may not be able, depending on how much you want to trade, there may not be as tight a bid and offer spread, or there might not be as much liquidity in the deferred quarterly contracts. But the questionnaire is correct. If we're in a state of positive carry, the further out you go in the quarterly cycle, the deeper the discount. And by virtue of using the futures contract to replicate the underlying risk, yes, it's going to converge up to spot. So you'll have a wider basis at the beginning of your transaction than you would if you went into the first quarterly month. But you're also potentially giving up liquidity to be able to get out. Remember, I mentioned liquidity is important. There's more liquidity in the front quarterly contracts. So in the event that same risk position wanted to exit the trade, they may find it a little more difficult to get out. So I agree with the concept. There's deeper discounting over time, but you're also giving up some liquidity. I would just like to point that out.
Okay, thank you, David. I don't know if anyone has another question to put on ours, and now in português. Não sei se algum de vocês tem alguma outra questão que queira aproveitar para colocar. Poderão utilizar aqui a linha de chat, efetivamente, aproveitar enquanto o David está disponível, efetivamente. Qualquer questão, eu não terei qualquer problema em traduzir para vocês, o que quer que seja. Por isso, peço a quem tenha alguma dúvida aproveitar estes últimos minutos para o fazer, para podermos aqui transpor para o David. David, we have another question. I was just talking in Portuguese to guarantee that everyone is attention to this. So regarding the Strangle, someone is asking about, besides the premium that you have to pay in the two options, call and put, why do you have to add the 2% distance to go to the break-even point?
The 2% was just the figure that I chose to use as an illustrative. Let's see. Here we go. You can go to any strike price that you choose. Generally, you want them to be equally distant from where the market is at the time of you're considering. I just picked 2% as a number.
Okay.
But let's think about this for a minute. The further away you go, in other words, if I had chosen 5%, I would have, my put and calls would have been further away, which would have meant the premiums would have been smaller, but the break-even point would have been further away. So this is a subjective trading decision, just like it is with the Strangle or with the straddle. When you elect to put them on, and depending on the premium imposed, it's going to have an impact on your break-even points. It's also, time is also another thing. Which option do you choose? Do you choose, in this case, we use the Decembers. You might want to use a monthly or a weekly that's got less days involved. The fewer days, the closer your break even, but you can get pushed out one way or the other. It's also going to have higher time decay. The wonderful thing about options that I like to remind people is that there's no such thing as a free lunch. Every time you get something in an options trade, you're paying for it. And anytime you're getting something in return, you're exposed to some kind of risk. So the Strangle costs less in premium, but you have to move further out to get your break even. If you buy a longer dated Strangle, you've got more time to achieve that breakout, but it's going to cost you more to do it. If you take a shorter dated view, you're going to pay less, but you could, if volatility remains or falls, you may not get your results unless the market moves beyond both your break-even points. So you're never going to get anything for nothing, but the strike prices you choose are completely your choice, and that is subjective depending on the trader's market view. The 2% was just the number that I threw out to show you how I arrived at my two strike prices.
Okay. Thank you for that, David. I don't know if anyone has another question. If not, I will thank you, David, for your brilliant presentation on this subject. Não em português. Obrigado a todos por estarem presentes aqui conosco. Qualquer dúvida que tenham, ainda têm aqui a oportunidade de colocar. Tal como falado desde o início, esta apresentação irá depois ficar disponibilizada para os participantes desta sessão e, inclusivamente, vai ser aqui partilhado um PDF, um deliverable relativamente a estratégias aqui muito vocacionado para opções, onde, por exemplo, estas duas estratégias, o Strangle, o Straddle, que foram aqui exemplificados pelo David, vão estar disponíveis. Qualquer dúvida também que surja posteriormente, vamos estar disponíveis, e relembro que para a semana vamos ter aqui a sessão prática numa versão mais trader, uma versão mais prática sobre a negociação e a utilização inclusivamente destas estratégias, novamente provavelmente aqui com um trader do BiG às 9h05, por isso estejam presentes, mantenham-se connosco efetivamente, e qualquer dúvida que surja até lá, é claro que vamos estar disponíveis. David, thanks again for your presence. Thanks again for all your knowledge about that you told us about these strategies today. And thank you once again for your time.
Thank you for having us. We're delighted to be a part of this program, and let us know how we can help you in the future. And my last comment would be to wish everyone the very best of luck and best of health. Thanks again, and good afternoon.
Thank you, David. Have a really nice day. Assim sendo, obrigado a todos pela vossa presença. A gravação do webinário ser-vos-á disponibilizada nos próximos dias, pelos mesmos meios que costumamos aqui disponibilizar. Qualquer dúvida, disponham. Resta-me desejar-vos a todos o resto de uma excelente tarde e bons negócios. Obrigado e até à próxima.